How's it going? Welcome back. It's Jonathan, and in this video, it's time that we go through our prior forecast and see where we're up to when it comes to this specific market. So the market we're going to be talking about today is not Bitcoin. I'm sorry for the Bitcoin folks out there. Today we're going to be talking about the Dow Jones because a lot of people have been saying that the past action over the last few days is crazy and that the Dow Jones or the US markets are tanking. So I wanted to go over the forecast that we've been putting out each month, and we're going to do basically a summary or a catch-up of the last 7 months to see where we're up to today. So the first one we're going to be looking at is just a quick update on what I was saying basically last month, or we should say about 20 days ago. The market topped out on the 24th of June. It hasn't risen above it yet. That's one trading day after the solstice. This puts us on alert for a decline in July if the market cannot break above and stay above the June high. That was important. We need to basically be watching to see if the market is going to stay above the June high. Now, the next thing I shared was the McWhirter method. And basically, if I can go ahead and open this up for you. This is the McWhirter method here, done from new moon to new moon, and it is based on her teachings in the theory of stock market forecasting, okay? Now, what we can see here is that we have a zero line down here, which basically means that the energy levels above this zero line are positive and should indicate mildly rising prices. However, we can see that as the energy levels decline, and as they rise, so do the markets, okay? And we were running into a downward biased month, especially for that July to August time period, where we were looking for that higher energy to basically drop off. Again, this is the McWhirter theory method. Not everyone's going to agree with it. Not everyone's going to know how to interpret it correctly. It's just one of the theories out there that we're following and using, okay? So the energy levels, as I like to call it, is down, which means we shouldn't be surprised if the strength of the move wanes for a little while. And then that's basically it. And we also put out the specific turn dates that we're watching for the month of July. So with that said, what we can see is that the bias on the McWhirter method was pointing down for July. So it was pointing upwards to begin the month and then pushing down. And then the same was for the actual forecast on the curves. Here we can see the red and blue one pointing upwards mildly to begin with, and then they were pushing downwards. So let's go ahead and take a look at the stock charts now. We're going to start off in January. I'm going to be showing you the curves and the actual market behavior since then. And I have a lot of things on here that we've just saved from prior months, but we'll just ignore them for now. So the bonds that we're watching are the red line and the blue line. These are our special forecasting lines that we're using, and this is going to be a monthly forecast. Okay, it's not a daily forecast, it's just specific for this month, and we'll just roll on each month. Okay, so the month of January we were suggesting that prices would rise up until around the first week or so, then they would fall. We have a weekend here, so they would fall until either the Friday or the following Monday, Tuesday time frame, and then they would rise from there on out. What we can see is the market traded down for a couple of days and then boosted higher into the top here. We had an actual top, which occurred maybe about 4 days later. And this low that was expected around the 13th basically came 4 days later. So we had basically a 4-day gap here where the forecast and the actual market data was basically pushed by 4 days. And then the bias was then that the market was then rise up from then on out. So pretty good call, pretty good forecast. And this is just basically using our forecast curves. And these are available in the Gann monthly forecasting service. And I also teach you how to create your own in our Gann Mastery program. Now this one here was a strange directional bias. We had two forecasts suggesting two different things. The red one was suggesting that the market would basically top out and fall and then trade sideways for the remainder of the month. And then the blue one, which is why we like to basically have both of these on here for a guide. The blue one was suggesting the market would slightly rise, then dip into around this period here, and then it would take off, trade sideways for a little while, take off at the end of the month. What we have here is the market rose up for a little bit, fell down, traded up into this range, traded basically sideways. The red forecast suggested a low on the 13th, where the market did actually create a low, bounced out of that, traded sideways, and then basically took off. So there wasn't great synchronicity in the forecast and also in the market. However, the directional bias, which we were looking for, we always look from basically left to the right. So starting low down here and ending up here, or starting up here and ending basically the midpoint of the range. We can see that the blue one, again, in this instance, has provided a good detailed forecast. Again, you can learn how to do these. We just do them the same way that WD Gann did, okay? Now for the month of March, we're looking for prices to go sideways, basically on the red and the blue, until around the first week, and then dip on the blue. The blue would then rally, and then dip again, and then it would rally, and then dip again, and then it would rally higher. Now, the curve for the blue one was the most accurate for the month. However, it did suggest that the market would finish lower than where it began. Where in this instance, we can see that the market ended higher than where it began. So it wasn't a good curve. However, it did depict a lot of the moves where we had this range here into a low, into a high, into a low. Then the market was to rally. Up until the 18th, the market actually found a high on the 21st. So about 3 to 4 days later. And then we were meant to have a low around the 24th. The market lowered on the 26th, about 2 days later, and then rally. So if we just shifted it across just a little bit, we would have been able to sync up a lot of those. If I can just shift this across, we could sync up a lot of these moves. Basically low, high, low. We had a weekend here, so it wasn't really easy to see. Market runs up, market runs down, market runs up. As for April, the bias for both of them was coming up into a top. Well, the blue one at least had a top on the 6th. The red one had a top on the 17th. However, the bias of both of them was to end, especially the blue one, and to end lower than where it began. The red one was to rally higher and then basically end where it started. As we can see, we have the 1st of April marking a top. The market ran down into the 4th, ran up into the 8th, down into the 15th, up into the 23rd, down to the 25th, up into the 29th, down into the 30th. So the blue directional bias was off with its starting point. However, with its ending point of being a bearish month, it was correct and giving us a good bias. Remember, we're using these as a bias for the month. We want to know if we're likely to be bullish or bearish for the month and where we're looking for turns in the market. Again, the point of me showing you this is to help you see that there's possibly a way that you can get your directional bias for the whole month ahead. Then we move into May. May's one did not go according to plan at all. This was wrong. We had this big inversion right here, okay? What is an inversion? Basically, it means that the market ran in the opposite direction of the forecast. So what we have here, if it's going to allow me to draw on the chart and not mess up, we have this period here where the market rolled under on the forecast, and we have this period here where the market rolled up above the forecast. So this whole period here is what we call an inversion. It's where the market does the opposite of the forecast, and it does the opposite almost to the exact manner. So we have this period here where the red and the blue were suggesting higher prices, and then these two forecasts were suggesting lower prices into this area before selling off again. However, what happened is the market ran up into this area and then sold off again. See this section here, which I'm trying to get at, is the inversion, okay? Geez, that's really messy. But that is the inversion. Alrighty. Nothing we can do about inversions. They come and go. We just have to know when they're inverting. And as the forecast keeps running low and the market keeps running higher, we know it's inverting for that time period. All right, so the June forecast was just suggesting rising prices throughout the month. Rising prices throughout the month. We're pretty on par. So it was a good call there. The next one, which is where we're up to now, is July. Okay, so this is the July forecast. What we had here was practically stagnant or rising prices into a top, which was going to occur on the forecast either around the 14th, which was a weekend, so around the 15th, or on the red one again, we had a double top around the 17th, and then markets were going to fall and roll over. Again, we can see in the actual price action here that the markets did indeed follow the forecasted curve. Instead of topping out on the 12th, they ran a little bit higher into the 17th, and then they topped out, and they're currently rolling over. So if the forecast is to be of any guidance to us, it looks like the market might get a slight rebound, possibly Monday. We do have this weekend right here. So possibly Monday we might get an update, and then it might be down for maybe a day or two more before they start to stagnate for the rest of the month. Now that doesn't go into the fact that we also have our solar turn counts. Now I haven't actually showed you those, but I've definitely showed you them in the past. But if we look specifically for the counts for July, we're looking for a turn on the 5th, the 9th, the 16th, 22, 27, and 31 of the month. Again, these are dates where the market is going to pitch a high or a low for that month, okay? So the 5th, on the Friday the 5th, we were looking for the market to make a reversal. In this instance, the market's running up, it's running down, hit a low on the 5th and reversed, runs up into the 8th, runs down into the 9th, okay? So that was the action then, runs down into the 9th. After the 9th, the market then ran up. Let's go ahead and take a look. The next one is the 16th. Oh, wrong one. I want my pencil back. Runs up into the 16th. All right, 16th is here. Technically, I would have been expecting the market to top out on the 16th. We always give it 24 to 48 hours max on a turn count. So in this instance, the market didn't top out on the 16th, topped out on the 18th. But that's the sort of action we would have been looking for. Rising, low, pushed up into the 16th. We would have been looking to cut our longs and possibly look for shorts. And then we're looking for a low possibly around the 22nd. So it's currently the 19th. 22nd is Monday. So we could get a pushover on Monday. Here's the two scenarios that could play out. Could push higher on the 22nd and make a top before running lower again. And then after the 22nd is the 27th. The reason why this might be more interesting is because the 27th runs down into this area. The 25th is a Thursday, 26th is a Friday, so be putting that onto alert. And then also at worst case, the Monday 29th. However, keeping in mind, we've also got the 31st on the cards as a possible turn date as well. So that's kind of how I would look at the markets and gauge current market action in line with the forecast. The forecast could have pitched a high on the 5th, possible low on the 8th. So we could have been looking for, from a forecasting perspective, a sell and then a buy. And then going over to this area here for a possible sell around the 16th. It's kind of the thing we look at. And then definitely be looking for markets to drop possibly down into the 22nd for a buy. However, since the market is forecasted, the actual curve is forecasted to continue dropping, then we would be looking for a possible bounce into a top. So we wouldn't be buying again. This is the sort of framework or thinking. We'd be looking for the forecast and the turn dates to be possibly leading towards a low around the end of the month. Okay, so I know that was confusing as hell. Basically, what I'm trying to get at is here is the markets can be forecasted both time and price, and we do price forecasting through the actual mass pressure charts, as Gann would call them. And we always want to be just confirming everything with technical analysis, okay? Technical analysis, whether it's Elliott weight theory, whether it's price analysis, price clustering, Fibonacci ratios, Gann ratios, all that sort of stuff. We always want to be confirming our theory. I know a lot of people were drawing channels. A lot of people are talking about Elliott waves in this time period. Basically, when we do the forecast and I provide you the curve, you want to then be overlaying your technical analysis to make sure that your technical analysis is also confirming that, okay? Now, one of the last things we want to do is just be looking at also the squares, and I always provide you the squares in the back end. Basically right here, if you take a look at this section right here, you've got the squares that are important for the month. You can see whether the squares are activating and whatnot. You also want to be getting your squares to be activating around your Fibonacci and price clustering and Elliott wave levels as well. Okay, the squares are going to be the most important thing for you because they're going to mark, more often than not, the tops and the bottoms of these moves, okay? Where the price clusters are going to occur. If it breaks through it, If it keeps breaking through it, where's the next one? You want to make sure that your price clustering, your Elliott wave theory, etc., is aligning to the squares, because the squares are so important. So you can just go ahead and pop these squares on your chart. Basically, this is using the square of 9 theory, and this is going to give you the forecasted price levels where support is going to be occurring in the market. And you might not think that these are important, but go back in time and you'll see more often than not, these squares have provided a level of support and resistance, sometimes even to the tick, in the markets. And we can just go back into the past and we can see just so many times tops, bottoms, tops, bottoms. There's not every single square I have activated in here. I've only activated what I believe to be the most important ones. But these, in combination with your natural support and resistance levels, Gann would often say that the squares are the most natural support and resistance levels. They are natural support and resistance before support and resistance actually becomes a thing, okay? What I mean by that is if we go into the future and we see that 42,580 is a square level, well, as the market runs up into this, is going to be a resistance level. The market's going to then fall down, and it's going to become a resistance level, hypothetically, okay? That's going to be a double top for those who are watching. And then the market will break through this, and it'll come down here to this square level here, and it's going to be a support level, okay? This is a support level into the future before these support levels became activated. Does that make sense? So these squares, we can go up as far as we want. These square levels will be support and resistance into the future before the market has actually activated that level. Alrighty, so that's all I have for this video. This is just an update on the Dow Jones. Let's see if we can take a look at anything for, let's take a look at June, because a lot of people watch different markets. So the June forecast for the S&P was basically bullish. We can see that that just played out. And then we had our forecast for July, and we can see it here. Basically same theory. Market was to trade sideways. In this instance, it was quite bullish to begin with, and it has broken above the solstice equinox dates, which are important. So the 22nd of June, I believe it was. But basically, it's down, okay? You can see that the forecast just suggests down, and this is how the market goes. If we look at the NASDAQ, not as always on point, okay? Sometimes it gets inversions. However, we always look for the end and the start. Sometimes it has very good calls, sometimes it has inversions. Okay, this is now July. So we had an inversion here where the market basically traded higher into this range where the forecast was suggesting higher and lower, and then get a correction lower. However, if the NASDAQ is going to push higher, it should push higher very soon and basically stabilize out. It does end the month higher than where it began on the forecast. However, given that the market had already pushed higher in the prior part of the month, it might not actually now push higher. Again, this is just an update on how to use the mass pressure charts if you're ever watching them or looking at them. Again, I try to do this from a non-advice point of view, where I don't want to give you the actual financial advice. I'm not licensed or anything like that. I'm just trying to teach you on how to use the analysis and how Gann would actually analyze the analysis. So I'll cut this video off now. And as always, just an update. If you want to learn more, you can just get in touch. It's pretty simple.